Hello, welcome to Applied Financial Accounting. On today's video, I'm going to cover accounts, debits, and credits. So basically, what we would be covering, so how a T account looks like, and what is debit and what's credit, and debit and credit procedures for assets and liabilities, owner's equity, owner's drawings, revenues, and expenses. So before I make the video further or the tutorial further, probably you should pause here and then read this disclaimer. And you can also, if you're interested to know who this person is making these tutorials, feel free to learn more about myself. So what is debits and credits? And in fact, the debits is always, they are on the left side and credits are on the right side. And then sometime when we also when we do the sum of the transactions, we have either debit balance for accounts like cash. In future slides, I'm going to show you when are we going to have a debit balance and when are we going to have credit balance. I will give you an example. Let's have a look at here. This illustration is explained in more details step by step. Bottom line from this slide, you need to understand that for T accounts, we have debits is always on the left side, credit is on the right side, and certain accounts like assets that have debit balance and credit accounts that have I'm sorry, I go back. I don't want to confuse you. So debits are always on the left side, credits are on the right side. Asset accounts have debit balance, and liabilities and equity accounts have credit balance, except withdrawals. We will go through this in details, don't worry. If you don't get it from this slide, I don't expect you to understand from this slide. So let's go step by step for cash accounts. So if you remember the first, the basic, not the first, but the tutorials on accounting equations, we had a case study. In that case study, we had several transactions on cash. Like we had cash inflows of $25,000, cash outflows of $6,800, cash inflows of $5,500, and then $5,000, and then cash outflows of $580, then cash inflows of $5,000, and then cash outflows of $2,080, and then cash inflows of $5,000, and then eventually cash outflows of $2,800. So if you sum all of these, it will give us $33,240. So what happens, because it's a cash account, or cash account is considered asset accounts, and so we write any transaction, any cash that was inflow on the debit side, any cash outflows goes on the credit side. So the sum of debits minus the sum of credits gives us $33,240. So that's actually how it works. So the question is that why do we study? Why it's important? So T accounts are used to increase and decrease depending on what the transaction is. So the key thing here is that it reduces the chance of errors. For example, because in an ideal, well, not an ideal, but any company has a number of accounts, so this way we will not make mistakes. Like when we know which transaction goes on the debit side, when transaction goes on the credit side, then it's easy, and then we are unlikely to make errors. I mean, it doesn't mean that we never make errors, but the chances are less. So then it also nets on both sides. And if you look at the this slide, so the sum of credits, the sum of debits are more than the sum of credits, and that's why this phrase is the debit balance of 33,240 means more debits or increases than credits. So that means we have more inflows in cash than outflows, therefore we have that balance. Now, debit and credit procedure. So debit must equal credits. Debits always must equal credits. And when debits and credits are equal in the journal entry, so that means this is why it's called double entry systems of recording transactions. That means both sides have to be equal. So I found an error here, so I need to fix this. As I said, I'm not editing. Systems of recording transactions. So both sides must be equal. Let me give you an example. So if you recall from this case study, you remember that? So on September 1st, Mr. ABC invests $25,000 in cash in the new business. And then what happens? So this is exactly, it refers to that, on that. So the investment of owner 25,000. So what we do is that the cash increases by $25,000. Then we, in here, we debit it. It's debit. And then we credit the owner's equity, the owner's capital, owner's capital by $25,000. And then if we look at the transaction number 2, what's transaction number 2? So we purchase equipment by $6,800. So we debit equipment by $6,800, and then we credit cash. We pay in cash and $6,800. These will be, don't worry, if you don't get it from here, I have a complete video following to this video where this is more a little bit theory. I have to do it. I know I always say that it's practical, but sometimes we will have to do theories. So that video will exactly gives you the practical understanding of what I'm talking about. The complete case study is given into T accounts. I'm going to show you that, how to do that. And then so here basically debit and credit procedures for assets and liabilities. If you remember, I just mentioned earlier that all asset accounts have debit balances. So that means a specific asset account should exceed credits. That in this example, you see all these, the sum of these 5 debit transactions on cash is more than the sum of 4 transactions on the credit side of the cash account. Therefore, we have 33,240. So that's what a specific asset accounts should exceed credits. That's what it means. And then the liability is the opposite. So let's say when the liability has a balance, so that means it exceeds the debits on the account. So I will also show you shortly in next slide. So basically what you need to take away from here is that whenever you have an asset account, debit increases the assets and debit decreases liabilities. However, when it comes to credit, increases liabilities and it decreases assets. It's the opposite. I know it's a bit confusing, but it will make more sense when I start journal entry and give you the following video on the T accounts. So let's give it, this is an example of liabilities. So if you remember, we had some liabilities with what we call it accounts payable. So we first had $2,200, so our liabilities increased by $2,200, and following to that we had $580, so that also increased our liabilities accordingly. Then we paid $580, so when we paid, that amount comes on the debit side. So when we sum $2,200 plus 580, you can take a calculator if you want, and then minus 580 gives us $2,200, and that's why it says normal balance or credit balance. So if you say this accounts payable has a credit balance, that means the sum of credit transaction is more than the sum of debit transactions. That's what it means. So then we have owner's equity. So owner's equity, so credit increases owner's capital and debit decreases owner's capital. So if you remember on the first transactions, let me get you back to this first transactions here. We've got $25,000. The owner invests $25,000. So what happens is based on this transactions, what happens is cash is increased by $25,000 and owner's capital is also increased by $25,000. So cash is debited and owner's capital is credited. So that means owner's capital, when we want to increase it, we credit it. So that's how it works. So how it works with owner's drawing. So just as a reminder, drawing means taking the money out. So when we make, you have a company and you need money, and you ask your accountant, hey, I want to withdraw money, or you have, the company's credit card, or you are debit card, you want to withdraw some cash, and then you just withdraw. That's what it means. So withdrawals are debited directly to the owner's capital, and that means we are taking the money out. So debit for owner's withdrawal means it withdraws money, or means anything that the owner withdrawals increased. So that means more debit, and the more debits we have on the owner's drawings, that means more money was withdrawn. Yes, and again, credit for owner's drawing means decreases. Okay, here we talk about revenues and expenses. So when revenue is earned, you remember we had a number of transactions where, let's say here, the company made sales. So when we have sales, so revenue account is, okay, I need to go back to that slide. Revenue account is credited, and and credit increases revenue and debit decreases revenue. So when you have a balance on revenues, that means you have the sum of credit transactions are more than the debit. So that's what it means. So when it comes about expenses, it's the opposite of the revenues. So in other words, so expenses, when we spend money, it decreases the equity, it decreases the revenues. So when we are spending, we are actually debiting. When we debit, that means it increases in expenses, and the normal balance of expense, as I mentioned earlier, is called debit. So with that, I would like to invite you to the next video, and that video gonna be the complete case study on T accounts. If you have any questions, feel free to leave it on the comment. I try to answer as soon as I can. Thank you so much for watching, and of course I should not forget, if you feel like this tutorial is helpful, please subscribe, share, and like. And I also get a feeling that okay, I'm helping some people. And again, I'm not benefiting from these videos. I'm not being paid to do these videos. It's just, I believe sharing is caring. Thank you.